Hello, I'm Toby Wells and I'm part of the team at Gerald Thomas & Co. And welcome to episode 2 of Toby's Tax Tips. In this episode we will focus on tax planning tips and tricks for limited companies and their directors. Tip 1. Is it a bird? Is it a plane? No, it's super deduction. This is part of the government's plan to encourage reinvestment in plant and machinery after an overall decline in investment with the tightening of purse strings as a result of COVID-19. This super deduction is an enhanced version of the existing capital allowances. These allowances enable taxpayers to write off the costs of qualifying capital assets against taxable income. This write-off reduces corporation tax in the process. The super deduction is here for 2 years and will apply from the 1st of April 2021 until 31st of March 2023 for companies investing in new plant and machinery. 130% super deduction will apply on capital allowances on qualifying plant and machinery investments, and a separate 50% first year allowance will apply to qualifying special rate assets. In layman terms, the super deduction will allow for companies to cut their tax bill by up to 25 pence for every £1 they invest. This is illustrated by the following example. A company incurs £1 million worth of qualifying expenditure for the super deduction. The £1 million spent equates to £1.3 million deduction when applying the 130%. With the current corporation tax rate of 19%, this will deduct £247,000 off the company's tax liability. Examples of eligible assets include computer equipment, tractors, lorries and vans, office desks and chairs, and refrigeration units. Tip 2. Companies can contribute towards directors' pensions without any immediate taxable benefit on the director. In line with the annual pension allowance, this can be up to £40,000 each year. However, if a director has not made any pension contributions for the last 3 years, the company can make a pension contribution of up to £120,000. For a profit-making company, this will result in a corporation tax saving of £22,800. On the same basis, a £40,000 contribution will result in a tax saving of £7,800. This is a popular way for directors to extract funds from their business tax efficiently and plan for retirement. Gerald Thomas provides an in-house wealth management team who can advise further on pension contributions. Tip 3. Extracting funds from companies tax efficiently. The methods for directors to extract funds from companies depend on if they are the sole employee or have other employees. Firstly, if they are the sole employee and have no other pay-as-you-earn salaries from pensions or other employments, it's most tax efficient to take a salary of up to the 2020-2021 National Insurance primary threshold of £9,568. Using this method, the company will pay a small amount of national insurance. However, this is the most tax-efficient approach under this scenario. An alternative where the company pays no national insurance is to take a pay-as-you-earn salary of £8,840, being the secondary national insurance threshold. Over the long run, this is marginally less tax-efficient. The remainder of the director's remuneration can be voted by dividends, as these hold a lower tax rate than employment income. If you're a director in a company with multiple directors or a sole director with employees, directors can take a salary of up to the personal allowance of £12,570 and claim the employment allowance available. There will be a small amount of national insurance contributions payable by the company and director, although the salary and national insurance contributions paid by the company will attract corporation tax relief. Additional methods of extracting funds from companies include directors charging rent on assets owned personally and used by the company. The rents charged will be tax deductible for the company, and the director can extract the funds generated from the assets without incurring national insurance charges. This will further increase in tax efficiencies with the newly announced 1.25% increase in both national insurance and dividends. Finally, if the company owes directors money, interest can be charged on these. The interest is a corporation tax deductible, and the first £500 or £1,000 can be taxed at 0% depending on the individual's taxable bands. Tip 4. Overdrawn loan accounts. Where directors and shareholders in a close company have drawn surplus funds out of the business, the company is liable to Section 455 tax. Section 455 is a tax of 32.5% of the outstanding amount owed by directors and shareholders, less anything settled within 9 months after year end. The Section 455 tax is due the same time as corporation tax, being 9 months and 1 day after the year end. When individuals pay back the loan from the company, it is entitled to reclaim the 32.5% tax paid to HMRC. However, this is reclaimed when the next corporation tax return is filed, so cannot be reclaimed immediately. To reduce the risk of overdrawn directors' accounts or loan accounts, it's crucial to maintain a record of the directors' accounts, consider voting dividends to clear the Section 455 if there is sufficient reserves, ensure that all business expenses incurred personally are recorded to offset against the loan account, and if the company does not have sufficient reserves to vote dividends, it may be worthwhile paying yourself a larger salary instead, although this will harbour a slightly higher tax rate. Tip 5. Loss relief. With many companies falling out of profitability as a result of COVID-19, restrictions, closures and changes to consumer patterns, the Chancellor announced a temporary extension to extend the carryback of companies' losses from 1 year to 3 years. Any eligible trading losses made by companies in accounting periods between the 1st of April 2020 and the 31st of March 2022 can be carried back 3 years and will be carried back against more recent profits in favour of earlier taxable profits. These losses are restricted by up to £2 million and are further restricted for groups of companies. Utilising the loss relief will provide a cash flow advantage. If you're in a position of using the loss relief, I would recommend preparing and filing your tax return as early as possible, as we've recently encountered that HMRC have incurred a backlog processing these claims. And finally, thank you for watching episode 2. Our team of accountants, tax advisors and wealth managers can assist you with both personal and corporate advice and planning. If you have any questions or queries, please contact us by emailing inquiries@geraldthomas.co.uk or by phoning 01792 465 155. We'd be more than pleased to assist.